Most outsiders look at a venture capital term sheet and see nothing but legal bureaucracy, administrative hurdles to clear before the money hits the bank. Take this standard 10-point term sheet for a hypothetical XYZ startup. The untrained eye zeroes in on three specific clauses: the $8 million pre-money valuation, the 1x liquidation preference, and the 4-year vesting schedule with a 1-year cliff. But this document exists because the reality of new venture markets is chaotic. These markets are defined by extreme, unquantifiable uncertainty, where the future cannot be accurately modeled or predicted. This creates a severe market failure known as information asymmetry. Founders hold private knowledge about the flaws in their technology, while investors hold proprietary knowledge about market realities and follow-on financing. In classical economics, the theoretical solution is a perfect contract, an agreement that anticipates every single contingency, is fully enforceable, and binds the parties so neither can take advantage of the other. In the world of venture capital, this perfect contract is economically impossible. Asymmetric information means the parties cannot map out every future scenario in advance. Because a perfect agreement cannot exist, the clauses in the XYZ term sheet function as embedded economic mechanisms. They are designed to artificially bridge the trust gap between founder and funder. To understand these mechanisms, we must look before money changes hands. Before signing, investors face massive pre-contractual information costs. The primary threat is adverse selection. Without clear information, investors abandon good opportunities, unable to distinguish them from lemons. Adverse selection is driven by two main factors. The first is bounded rationality, the reality that individuals have a limited capacity to deal with the staggering complexity of a new startup. The second factor is impacted information. Both the founder and the investor are naturally incentivized to distort or hide the data to avoid being exploited by the other side. To break this deadlock, economics offers two solutions. The first is signaling. A signal is a credible demonstration of quality that doesn't require revealing trade secrets, like a startup hiring a top-tier investment bank. The second is screening. Here, the investor offers a menu of alternative funding terms. The founder reveals their true confidence level simply by which specific set of terms they choose to accept. These solutions lead directly to Clause 2 of the XYZ term sheet, the pre-money valuation. This figure is derived from the post-money value, which is the negotiated share price multiplied by the fully diluted shares outstanding. The pre-money value is then inferred by subtracting the actual investment amount from that post-money total. Comparing this value to the prior round's post-money value determines the firm's trajectory. A positive change indicates an up round, while a negative change signals a down round. That $8 million valuation is the mathematical output of the screening and signaling processes navigating the threat of adverse selection. Once the deal is signed and the funds are wired, the nature of the risk changes. We move into the post-contractual phase, where the primary problem is no longer a lack of information, but a conflict of incentives. The friction is structural. Now that the entrepreneur has the capital, but has given up a portion of their equity, their personal financial incentives may no longer align with those of the outside investors. For instance, a founder with outside capital might want to take existential risks with the company that the investors, who provided the actual cash, would prefer to avoid. The economic countermeasure to this risk is monitoring. On the XYZ term sheet, monitoring is codified in Clause 3, the right to appoint a board member, and Clause 9, information rights. Information rights require regular financial statements, a form of indirect monitoring to verify that capital is being deployed as agreed. The board seat provides direct monitoring. It allows the investor to observe executive behavior and decision-making. These rights are not just about advising the founder. They are engineered legal tripwires designed to detect and prevent a divergence in incentives. But monitoring is only effective if there are consequences. This requires a mechanism called bonding. In economic terms, a bond is a penalty paid by the party who breaks a promise. It gives credibility to a commitment by making opportunistic behavior expensive. Clause 7, the 4-year vesting period with a 1-year cliff, serves as the primary bond in venture deals. Under this system, equity is earned incrementally. The 1-year cliff is a blackout period where the founder earns 0 equity. If they leave early, they walk away with nothing. At 12 months, 25% vests instantly, accruing steadily thereafter. This cliff is a structural bond guaranteeing founder retention during the startup's most volatile initial year. Clause 4, the liquidation preference, and Clause 5, anti-dilution protection, serve as secondary bonding tools to protect the investor's downside. These tools ensure risk is allocated to the party who can bear it at lowest cost, forcing the founder to share the financial pain if their initial promises fail to materialize. When these mechanisms align, the contract reaches a point where it exhausts possibilities for mutual gain. This means the terms are so efficiently calibrated that any further shift would penalize one party without providing justifiable benefit to the overall relationship. Pulling back from these micro-clauses reveals the contract as a holistic ecosystem. We have seen the machinery, the rules. Rule-based contracts rely on explicit, measurable procedures, like the exact math of a vesting schedule. But rigid rules can lack flexibility. In an unpredictable venture environment, following a script too closely can prevent the parties from adapting to new information. This is why the deal also incorporates principle-based elements, overarching values, and broad guidelines that govern the relationship when specific rules aren't enough. A successful venture deal synthesizes both. The term sheet provides the rigid rules for equity and control, while the broader operating agreement uses principles to allow for creative problem-solving and innovation. The components of a term sheet, valuation, board seats, and vesting, function as the physical implementation of signaling, screening, monitoring, and bonding. Ultimately, a term sheet is an economic blueprint designed to manage the friction of asymmetric information and misaligned incentives.